Carl, if it don't make dollars, it don't make sense. This is weekly sense.
That's right. And we've been dealing with rare volatility around expectations on inflation and in the treasury market.
Right. Yeah. So today's show, we're going to cover three main topics. The first one is covering this is the second worst start to a market mid-year in history. Number two, we're going to cover some of the catalysts that we see that would have to happen for a recovery. And then lastly, we've got to talk about the huge drop in Treasury yields or bond interest rates just over the last week. It's been pretty large. So let's kind of kick off there. The first one, which is kind of reviewing the worst start in history, the second worst start in history. So this is from Ned Davis Research. And what this chart looks at, Carl, is the drops through mid-June historically. And you can see 2022 is only second to 1932, which was the 36% drop in 1932 for the first 6 months of the year. And then what it shows is kind of what's happened throughout the remainder of the year. But what is constant other than 1940 is you've seen some pretty significant recoveries from the depths of the mid-year drops in some of these previous cycles. And the length of those bear markets obviously vary. So what are your thoughts on kind of, just this right here?
Well, that's one of the things that gives us confidence that, we don't need to be getting too defensive too quickly.
Yeah. Things
could rebound because that's been the history, particularly if you go back to the Carl's Desk commentary that I sent out last week, they're talking about the history of bear markets and how they've behaved and how things have rebounded. One of the key things is that large bear markets where you have a decline that's more than 25 to 30% or so, the big ones that are down 40 or more, those don't happen typically really quickly. They typically unfold over an 18-month or more period of time.
Yeah.
So even if we are in something like that right now, and for a lot of reasons, we don't think we are yet, it's not going to go down in a straight line. There are going to be bounces, big bounces over multi-month periods.
Yeah,
and I think that's what you see captured in this chart, that, even when you have a big decline through the middle of the year, the rest of the year bounces. And, even if the full year ends up being negative, and I guess in the case of 1970, I mean, that was when inflation was starting to pick up, at the end of the 1960s, and there was they were on the brink of a recession there, and you had a big rally. We went back and looked at those markets, and interestingly, you had sell-offs in response to inflation, but you also had big rallies over the next 6 months to a year as the Fed was starting to raise the Fed funds rate.
Yeah, is that deja vu?
It feels a lot like the environment that we're in right now, and that's kind of what my base case assumption would be for the next 6 to 8 months or so, some kind of a rally.
Yeah, and it kind of gets back to the old adage of, try not to get cute, right? When things are down, you probably should trade less often. When things are up significantly, you should probably trade a little bit more often, but sometimes, individuals don't do that. So what we wanted to show by showing this chart was, yes, it is the second worst start in stock market history going back to the 1930s. But if we look historically, there's been these severe or significant, I should say, significant rallies where the stock market, finished a lot higher than where it was. So with that said, Carl, what's our point of view with regards to what are some of the catalysts? And I'll start first and I'll let you go. I think a big catalyst would be some kind of peace treaty in Ukraine. I mean, I think that would ease energy prices a lot. Obviously, that would flow through the economy. But other than, maybe a peace treaty in Ukraine as being a positive catalyst for a surprise that investors really aren't pricing in right now, what are some of the other things that could cause the market to, potentially go higher over the next 6 months?
There are a few that really come to mind. I think the most likely thing is I don't think it's real likely that there's going to be a peace treaty or anything like that happening in Ukraine, even if this conflict settles down, the disruption in commodity markets is there. But one surprise could be that the rest of the world ramps up oil drilling capacity and they figure out how to close that gap that the war has created in the supply for energy commodities, and also I think the agricultural ones is probably going to be a little bit more difficult because you have to get land in order and set up to grow crops, and that's not something that can happen probably as quickly. But look, we've only been into this for about a quarter, so the energy industry, it takes them some time to react, and that could be a surprise. But maybe over the next 6 months to a year, a little bit, but that's kind of on the quick side of everything there.
Sure.
Probably the bigger, like one of the bigger ones that I can think of too is that we're in a mid cycle election year right now, and once you get past the midterm election, typically you have a rally. If we get some change in Congress, like that could be something that gets people excited. So that's a big thing. I would think that's pretty likely.
Yeah, I've got a simple
next year
one.
and into the first quarter.
Yeah, I've got a really simple one. How about if we just don't have a recession this year?
Yeah, I mean, there are a lot of reasons that we don't think we're in a recession yet. So if that becomes clear to people in another couple of quarters or by Thanksgiving, then that certainly could be something that causes a relief rally.
Yeah, so peace treaty in Ukraine, ramping up oil production, not having a recession this year, and maybe corporate earnings not being as bad as what people are forecasting, or at least some of the analysts are predicting on the talking heads on news networks. I mean, those are all things, as investors in the market, we're taught that at any given time, the market is priced for all known information. And it is also based off of what the market is assuming, whether that's assuming aggressive Fed policy, assuming a higher probability of a recession, assuming that Russia and Ukraine continue, assuming that China continues to slow down the ramp up of opening up the country a little bit more to help with the supply chain. So if it's assuming all of those things and we get any kind of positive catalyst in any of those, it can cause these relief rallies, much like what we saw in 1932, 1940, 1962, 1970, and those previous years that we saw those relief rallies after the pretty significant drawdown in the beginning of each year.
Right. I mean, and the main reasons, we don't feel like we're in a recession yet are that we just haven't had that many Fed funds rate hikes yet. And you need to see unemployment ticking up for a 6-month period by about 0.5% or so. And then you also, at least the last 3 business cycles, you've needed to have the Fed funds rate peak and then start to see the rate cuts after the rate hikes.
Yeah. Okay. So we covered the second worst start of the year, some of the catalysts that can propel the market higher between now and the end of the year. I think the biggest thing that really hit the news cycle this week was the dramatic drop in Treasury yields. So I wanted to pull up a chart. This is just the 10-year Treasury. Now, this is as of yesterday. It's not priced for what happened today, but 10-year Treasury yields, as well as even 30, but this is the 10-year specifically, dropped over 10% in 1 week. I mean, that's a significant move, is it not?
It is. It's happened before, but I don't know that there's been time when it's happened this quickly.
In 1 week. Yeah, 1 week.
Week.
Yeah.
Maybe it almost looked like it got there like during the COVID crash in March of 2020, but it's rare to have bond yields moving around so much, because that's supposed to be where the safe money is, and it just doesn't move that much.
Sure. So tell me why that happens. Now, obviously this entire year, we've seen an extreme amount of volatility, not just in stocks, but also in bonds, something that a lot of investors haven't even seen, going back to even the 1970s, this extreme movement, both to the upside and the downside in the safe money portion of the portfolio. So what causes these kinds of things?
Well, there's just been significant surprises this year around inflation, particularly after the war started. And then following that, there were surprises in what the Fed would do with hiking the Fed funds rate, shrinking the balance sheet. So you have surprise on top of surprise. And now more and more people are talking about a recession on the horizon.
Right.
And whenever and oil prices fell a lot. Oil and natural gas prices both fell a lot this week. So that's also something where Treasury yields are highly correlated with changes in inflation sensitive commodity prices like oil and gas, but copper was also falling this week too. So
well, and it's going to help. It's going to help anybody, locking in a mortgage, right? If you see bond yields falling as much as they have just in this last week. But I just find it extraordinary. Yeah, maybe they're pricing in a larger probability of a recession sooner rather than later, which typically during a recession or even before a recession, you see peak yields is what we saw in a chart earlier today on the terminal. So I think it's just really interesting when you're starting to see this kind of price action in bond yields. And like, to your point, we haven't seen a significant move like this in a short period of time, maybe ever.
Right. So we're watching all of this carefully to try to figure out where the peak in Treasury yields is. It's possible we may have seen it because this was a big downward move really quickly. But I think it's a little too early to really confirm that. I think we need to probably see another month's worth of inflation data, get through the second quarter earnings season and see how much corporate earnings are affected by the stronger dollar. Get a better feeling for how well all the different sectors of the economy are doing. Then we'll have a better feeling. And another surprise is that maybe with enough reduction in the value of asset prices, even though we haven't had really a meaningful increase in unemployment, although you do hear about layoffs at a lot of tech companies, particularly startups, we might just have inflation starting to decline in response to all of that with a negative wealth effect. Asset values aren't worth as much, so people aren't willing to spend as much. That's possible. Maybe we could see some of that over the next few months.
Yeah, significant drop in yields though. So, okay, just to summarize weekly sense this week, we talked about the worst start to the year. We showed some of the other worst starts to the year. Most of them had significant recoveries for the latter half of the year. We talked about some of those catalysts being some kind of reprieve in Ukraine, ramping up oil production to bring down energy prices, which, by the way, we've seen drop from $120 or $122 a barrel to, I think it's like 105 or 106 right now. That's also a pretty significant drop. You've seen energy stocks get demolished over the last 3 weeks. I think down, somewhere between 20-25%. And then some of the other catalysts would be, if we didn't have a recession this year, that's probably being priced in a little bit too much. And then the changing of the guard at Congress, that could be a positive catalyst as well, one way or the other. And then finally, just to wrap it up, bond yields dropped probably the most in a short period of time, down about 10% in a week, pricing in, potentially probabilities of recessions. So did I miss anything?
No, you got it all. Great summary, Andrew.
You're a rock star. Thanks, everybody. Thanks for watching.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.